The stock market's panic index, known as the VIX, has surged to its highest level since the pandemic. The fear gauge, as it's known, reflects expected volatility in the stock market over the next month, with higher readings indicating increased stress. President Trump's tariffs are stressing many, contributing to the uncertainty, prompting even casual investors to keep a close eye on the index. Recently, the VIX peaked here at 60.13. It's now settled back into the 40-50 range, signalling potential market declines, but it's no doubt watching and raring to run. Joining us here in the studio to discuss this is Dr. Stephen Entickett from CI Attacks. Great to see you here, sir. Talk to us about the VIX. What is it and why should we be worried?
Well, I don't think we should be worried at all. I think it's an opportunity here. So the stock market does run on the two famous words, fear and greed. So, you know, when the market's going up, people are missing out and they're piling in and they're wanting to make money like everybody else. I say when the mum and dads finally tip into the market, you can generally expect a drop at that point. So the market is driven on fear and greed. And the measure of fear is the volatility index, the VIX index. So the option brokers, if you like, and they're more like insurance agents, who will sell a contract to buy and sell a share over a 30-day period on the S&P 500. Now, if they think the market's going to move a long way, like good insurance companies, they'll put the price right up. So these guys have got a job. They just sit there, ladies, females, computers, AI, everyone's looking at the markets going, is it going to go up or is it going to go down? If they think it's going to go up, and the moment you get some scare into the market, like tariffs, COVID, whatever, they think the market's going to go really badly. So they increase their risk. Well, if I'm taking this risk, I want to be paid more. So that pushes the volatility index up. So we have real data, people making real money and losing money, insurance agents, if you like, who are going, hang on, it's a bit tossy-turvy here. It's going to cost you a lot more to buy protection.
What I find interesting about the VIX is that it's really volatile now with a trade war that nothing has actually really happened just yet, right? We haven't seen the ramifications. And it's the highest level since the pandemic. But since the pandemic, we've had a war in the Middle East, which has pushed up oil prices around the world, and then the war in Ukraine as well, which is a nuclear power having a proxy war with another nuclear power via Ukraine. It's incredible that this presidency has led to that volatility. But knowing Donald Trump, it's essentially a Trump gauge.
No, I think you're absolutely right, a Trump gauge. I think we're probably going to see a lot more movements in the volatility index over the next term of his presidency. But you're absolutely right. It predicts the future. So it's saying, well, over the next 30 days, we think the market's going to tank. I want more for that risk premium I'm selling you. So all of a sudden, the VIX, which hovers around 20 or below in quiet times, but as we've seen, as you've rightfully said, it jumped right up into 30, 40, 50, 60 pretty quick when the option brokers thought, hang on, we're going to lose money here, you're going to pay me more.
Okay, so if the VIX says the next 30 days are going to be a bit of a roller coaster, how do we as investors respond to that now? Is it best to wait it out, or is it best, you talk about fear and greed, often fear and greed is week to week, you'd think, but we are seeing it hour to hour, minute by minute in the stock exchange, where you see a massive drop at the open and then it recovers through the day and then drops again at the close. So how do we respond to that?
Well, with excitement, I think. I think most people, when they go into the fear mode, they retreat into their shell. But look at Warren Buffett. He'd been putting aside billions and billions and hundreds of billions of dollars, knowing that it was only a matter of time before that fear index.
He's cashed up.
He's well and truly cashed up, and he's been dribbling that money into the share market, no doubt. In Australia, we have super funds who are mandated to put money into the market. Every time superannuation comes into their accounts, they put it into cash. They look for opportunities like this so they can enter the market. People like myself, I generally kept a 20% buffer in cash when the market's going really, really well, because it's only a matter of time before it does. Monday morning on the open, after that big crash, I was feeding every bit of spare money I had back into the market, and that money's looking pretty good, and it brings that dollar cost averaging down. So I think we have to look at it in real terms. There's a great book called Anti-Fragile, which says it's only a matter of time before something happens. And you've got to plan for it.
Yeah.
So if you sit there going, well, okay, the market's down, I haven't got any reserves, well, bad luck.
It's interesting you love to use the term calm and committed, and the VIX is kind of the opposite of that, but it's really about the mindset, isn't it? I want to talk about superannuation, which you mentioned, because something that we keep being asked about by viewers is superannuation and how it's going to impact them, because they see markets crashing and they think, uh-oh, particularly people of a certain age who are moving into that retirement and about to start drawing down on it. What's your advice to people in that situation?
Well, if you were in a high risk area of superannuation, which you probably shouldn't be in your 60s, 70s and 80s. You should be coming back to a lesser risk exposure. And the market's taken a tank. You know, the best strategy I find, and governments usually allow it as well in really bad times, is they'll allow you to reduce the amount of drawdown. So if something's $100, it's dropped to 80 and you pull out 20, it can't recover to 100 ever again.
Yep.
If we get a quick. So look, if you can slow your drawdowns down in these periods of higher volatility, and look to increasing your drawdowns when markets are a bit more stable.
And the other thing as well is there's an opportunity for everything, right? So if the stock markets are dropping, there's gold, and gold we are hearing is going to hit record highs, right? There's talk about $3,500, and now there's talk about $4,700 an ounce too. What do you think about those sorts of things?
Well, I love gold. You know, I bought a pile of it around that $1,500-1,600 because fundamentally it was too cheap. So I've been sitting on that gold. Now it's over 3,000. I'm thinking about cashing that gold out and moving into another because it's had its run.
Yeah.
Generally, when you hear the talk about, oh no, it's going to go to here, it's going to go to here, it's going to go to here, often enough that triggers a bit of a decline. So I'd be a little bit cautious with gold. Myself is it's already doubled. It's doubled in the last 18 months or so. Can it keep doubling and doubling and doubling? I don't think so.
When we look at the VIX and we talk about how it indicates the stock market, it's important to remember, of course, that the stock market and consumer sentiment are very different things. Sometimes they align, but not very often. And a great stock market doesn't necessarily mean the economy is going well. We talk about the VIX, but what about all of the recession warnings we're hearing with some really senior investors who've been around a long time saying they're not fearing recession, they're fearing something worse, more like a Great Depression. What are your views on that?
Well, I think we're already starting to see the Reserve Bank have pretty much come out in Australia and said, yeah, we are going to have a May cut. So they're concerned as well. So if we're starting to talk about central banks reducing interest rates again, they're trying to stave off what is probably an inevitable recession or depression. It's just a matter of which decade it might be, in this decade or not. So look, I'm probably not convinced there's going to be a major crash. I believe the world's got a vested interest in continuing on the way it is going on. But sooner or later, with this giant debt pile up and lack of productivity around the world, political uncertainties, something's going to hit the fan at some point.
The debt, that's an interesting one, right? Let's say at the moment you've got credit card debt, you've got a mortgage, you've got a car loan. Is it a good idea to get ahead of your repayments right now or to store the cash?
Yeah, well, it's probably both. You know, at the end of the day, interest rates should come down, and hopefully it'll come down on those consumer credit products as well.
Yeah.
But look, I'm a big believer in having an emergency fund. You need reserves. You need an emergency fund. You don't know what's going to happen with your job. You don't know what's going to happen with your superannuation drawdowns. You don't know what's going to happen into the future. So keeping a buffer, very good plan.
Stephen Entickett, appreciate your advice, and of course you can catch Money Matters right here on Ticker. Head to the show page, catch him every week here as well. Good to see you.